Hey guys, welcome to another episode of me, Shashank Udupa. And in this episode, we're going to talk about something that a lot of you guys have a problem with, and that is basically how to analyze banking stocks. Now, this is something that I have seen a lot of people can't do. It's not that they can't do, they always have this fear that, banking business is so different from the traditional business, and it's very difficult to read their account statements. It's very difficult to understand how their balance sheet works, how their profit and loss statement works, and usually you tend to stay away. So in this episode, we're going to tackle that very big concept, which is how to analyze the stocks of banks, how to analyze the banking stocks with respect to a lot of other factors. And basically, we are also going to tell you how to analyze their profit and loss and balance sheet and what to look at, right? And I know a lot of people get scared to read the banking stocks and read and understand everything about them. But let me tell you this: if you know how to read the banking stocks once, and if you learn how it does with one bank, it is the same across every other bank, right? So you only need to understand how it works once. But don't worry, if you don't understand, there's no problem. I'm here for you. Let's do it together. So in this episode, what we're going to do is we're going to analyze a particular bank stock, and we're going to focus on four main things. Now, what is the four main things when we analyze a particular bank stock? We're going to look at what the bank actually does, because there are slightly different type of banks also. So we look at what the bank actually does. We'll look at the price of the bank. Okay, we'll look at how it prices itself. We'll look at the earnings power of a bank. And finally, we will look at the amount of risk that this bank is taking to achieve that earnings power. Now, all of this is very important to understand how to analyze a banking stock. So let me clear it out very easily and try to put it in a simple format for you. Now, the first thing that we will look at is what does a bank do, or how does a bank make money? Now, first, before I get into anything, okay, there are three types of banks. Let me explain that first, and then I'll come to what a traditional bank is. Now, there are three types of bank. One is that we see all around, the traditional banks and the commercial banks. What do? They primarily make money by lending their money out to people. They primarily make money by lending or giving loans to people and getting some interest on that. These are traditional banks. So basically how they make money, okay, they give out loans to people and they charge a high interest rate for it, and whatever money they make, they keep it with themselves and they make money with it. But how do they get this money? From normal people like us, where we go and put deposits in the company, in their bank account, we go put deposits. They pay us a small amount, they pay us a particular amount of interest also on our savings or fixed deposit, and with that interest they have to give it back to us, but they take that money and lend it back into the market, and they take a higher interest rate from that market. So these are traditional banks. Traditional banks primarily make their money from lending purposes by giving loans. Very simple. I'll come a little more detail into that. Next, there is another type of bank known as investment banks. Now, investment bankers or investment banks, if you look at what they do, but what they do is they do a lot of services business, right? They advise people on how to do mergers and acquisitions. They advise people on how to raise equity and debt, right? How to do different kind of debt and equity restructuring, how to handle wealth for a lot of HNI clients or high net worth clients. So they do a lot of these kind of business, which is very services based business. Then the third type of bank, okay, which is also known as universal bank, is a mixture or combination of the first two banks that I explained, which is one that does lending and the investment bank. Now, if you look at it, a lot of banks are coming out with all of these services, including investment banking as well. Now, you said, okay, now Shashank, now I understood how the banks work. Okay, awesome. Now, when I go into a company's balance sheet, right? If I have to go into the balance sheet, how do I understand what type of company it is? Now, in balance sheet, there are two things: assets and liabilities. Now, if you go to a balance sheet of a bank and you look at their assets part, okay, I'm only talking about the assets part, you will understand that firstly, you need to know that loans are a very big part of the bank's infrastructure, right? Now, the greater the bank's loans as a percentage of their assets, you understand that it is a traditional bank. Because if I had to do an investment bank, I'm only giving advice to people on how to do mergers and acquisitions, how to, manage your wealth. So I don't need to give them loans, right? But if you look at a balance sheet of a bank and you see too much loans are there in the asset sheet, that means it is a traditional bank. That is how you understand. Now, the second thing that you will look at, you go to liabilities. Now, in banks, it is ulta, right? It is slightly different. In banks, deposits are considered like liabilities. Deposits is what people like us putting deposits into a bank account. Now, what the bank basically does is, imagine Shashank Udupa puts a deposit into the bank account, and the bank says, okay, for this deposit, I will give you 5% return. I'll be like, thank you. Okay, give me 5% return. Now the bank takes my money and lends it to someone else like Rahul and says, Rahul, you have to give me 15% return. per annum, right? So now how much does the bank make? They took the money from me at 5 and gave it to Rahul at 15. So the bank make 10% return in the middle. That 10% return is known as net interest income, or it is also known as NII. Okay, I'm just keeping it out there, but I'll tell you what it is basically it means. But that is just a thing. Please remember that. Now, a lot of analysts in the banking sector look at something known as a CASA ratio. Okay, you might have heard of this. It's called CASA ratio. And what is CASA ratio? CASA ratio is basically CASA ratio. CA is current account, SA is savings account. Now, a bank that has why they look at current and savings account? In savings account, the bank has to give some interest back to people, but in current account, you don't have to give a lot of interest back to the companies, and companies keep a lot of money fixed, right? But in savings account, you have to give 4-5% back to the people. So a good healthy ratio of a lot of current accounts and savings account is considered a good thing. But again, if you have too much current accounts and less savings account, current account you can shut down and go anytime you want. There's no, savings account is very difficult to close at that point because it's your entire life savings. So some people, what they do is they look at CASA ratio as well. A healthy CASA ratio is the more the CASA ratio, the more current accounts to savings account, it is more profitable for the bank. So basically now you understood how the bank makes money, and in the liabilities side, you will see this element of the deposit side element. Now, balance sheet we understood. Now you tell me, okay, Shashank, let's go into the, what is that, profit and loss statement. I'm confused there also. It is so difficult to understand because there is no revenue from operations. It's slightly different. Now I'll tell you what is different. On top, when you open a profit and loss statement of a bank, you will see something known as NII, okay, which is net interest income. Now, what is interest income or net interest income, or what is normal interest income? As I just mentioned to you right now, they primarily deal in the business of lending. Okay, and they lend some money and they get some money in return. That is only they get the interest, and that is their pure profit that they earn, right? So the first way the bank makes a lot of money is called interest income, which is the main source of business, which is called interest income. Net interest income is basically the difference between the amount of money that they have to pay the depositors, right? Pay people like me who's deposited money with them. And it's the difference between that interest income, which I told you, 5% they have to give me, but they took 15% from Rahul. So 10% becomes a net interest income. So that is what net interest income is. Then there is something known as non-interest income. Now we said the traditional business model of a bank is to take interest. Yes, they take money from me and give it to someone else, that they loan it to someone else at a higher rate of return. And when I ask my money, they give me 5% back and they make 10% off Rahul extra, right? But what is non-interest income? Non-interest income, now you might have obviously seen this, that in banks there are some, when you try to open an account, there is some account fees or account opening fees, or you're trying to do something, there is some banking fees. You try to trade in something, you do some trading in some banking facility, again there is some fees attached to it. Now this fees is different. It's not equal to interest, right? It's not like they're giving you loan. So all these fees come as a part of non-interest income. Okay, because they're not a part of interest. The main primary lending is interest. This is non-interest income. Now, there's no good mix between what should be the interest income and what should be the non-interest income. Ideally, it should just be growing constantly. But what people look at a lot in the industry is the NII, which is net interest income growing. Why do they want to see whether the net interest income is going? Because if Shashank is getting 5% back, the bank is giving Shashank 5%, but tomorrow they're giving it to Rahul, but not at 15, but they're giving it at only 10%, then now suddenly the bank makes only 5% return, right? So they ideally want the NII to be much more, where they can give loans at a higher rate and get more return, and obviously give it to Shashank at as lowest rate as possible. That is how it works. Understood? Very simple. So this is how you look at the balance sheet of a bank, and this is how you look at the income statement of a bank. And we understood what the three types of bank are. Clear? Next, we will look at the price of a bank. Now, the next thing that we will look at while analyzing a bank is the price. Now, obvious goal for anyone who's investing in the stock market, even if it's banking stocks or not banking stock, it is to buy something that is undervalued, okay, which is not trading at its actual value. But when it comes to banks, there are two most important valuation metrics for us to look at. One is the book value and one is the tangible book value. Now you'll be like, what is tangible book value? Isn't it the same thing? There's a slight difference. Now, if you're not familiar with what a book value is basically another word for shareholders' equity or equity, right? So if a bank is selling at book value, that means the bank is selling at the same, or you're buying into the price that is equal to the equity. Equity is nothing but assets minus liabilities. Okay. Now, this is why we look at assets and liabilities so much in banks, is because the entire banking industry is pegged to each other with respect to their assets and liabilities, which involve their loans and deposit. So we can only compare them in that perspective. Now, let's understand a little more important. Right now, we look at something known as price to book ratio a lot when it comes to banks, which is the price of the company to the book value of the company. But if you really want to be conservative, you should look at the price to tangible book ratio. Now, again, what is tangible book ratio? In the normal price to book ratio, there are some things, okay, that are there in the balance sheet of a firm, which is known as intangible assets. Tangible is something that I can touch. Intangible is something that you cannot touch. Now, what is intangible assets? It is assets such as goodwill. Okay, there might be different things. I'll talk about goodwill, right? If you look at goodwill, the concept of goodwill is basically comes when a company is looking to acquire another company, and you'll be like, see, my company is such a great company. The brand value of my company is so good. The goodwill of that company. So they put a price on goodwill also, right? So that is intangible. Okay, it's fictional, but it's a price on goodwill as well. Now, apart from that, there are other things that might come into intangible. Like, for example, a company might have a good loyal client base, good brand identity, might have something like a proprietary IP technology, which again, you can't put a price on it, but it is priced, right? There is proprietary technology, there's amazing workforce. So they put all that in the intangible assets. So if you really want to analyze the stock, you remove the intangible assets and then look at the price to actual tangible assets, which is basically your loans and deposits. You need to look at that from that example. But again, what I'm trying to explain is these are ways to look at it and understand it from a valuation perspective. Does not mean that you just look at a bank stock and the price to book ratio is cheap and it's undervalued and you should just go buy it, right? It is very important to understand whether this bank has a future, whether their net interest income is growing, their net interest margin is growing, whether their NPAs are growing or not. I will come to all of that in the next segment. But it also, we need to really look at whether this company can grow, whether its earnings power is increasing a lot, and whether it is less risky or not. That is what you really need to look at in a bank, not just the price to book ratio. Now, the next thing that we need to analyze when we do analysis of a banking stock is something known as the earnings potential of this bank. Now, there are a few ratios that we will look at from an earnings perspective. The first ratio that we will look at is something known as ROE, or return on equity. Now, return on equity in a very simple sense is basically the amount of money that is being given back to equity shareholders, or the amount of money that a company is making, net profit a company is making with respect to the total number of equity in the business. Now, obviously, a higher ROE ratio signifies that the company is able to get or generate significant amount of returns with respect to its shareholders' equity. So higher ROA returns can also justify a higher valuation on the bank and also justify a higher price to book ratio. Why are people paying more amount for a particular bank? Maybe because the ROE is high. So that is a possibility. Another very important metric to look at is something known as NIM. Okay, percentage. Now, I spoke to you about NII, which is net interest income. This is NIM, which is net interest margin. This is nothing but the difference in the percentage of deposits versus lending. As I told you before, the bank gives Shashank 5%, gives Rahul 15%, gives loan to Rahul at 15%, but gives Shashank 5% for deposits. So the net interest margin between the two is 10%, right? Net interest income is different. That is income of how much they're earning from Rahul and how much income how much they're paying back to Shashank and the income that they make. So basically the interest margin is always good when it is growing, because that basically means that I am giving loans and securities at higher rates and I am giving deposits back at a lower rate. So obviously a growing NIM is considered a good thing. Now, a third ratio that you can look at from an earnings potential is something known as an efficiency ratio. How efficient is a bank? Now, why is efficiency ratio so important? Because the main business of the bank is what? It gives interest, it pays some kind of an interest to the depositors, does a lot of lending, gives it to the loans, gives loans to people and gives them a higher rate of interest. Basically lending they'll keep doing. But what is the cost of this? Right? You need to have a lot of compliance people, you need to hire a lot of people in your organization, you might need to set up a lot of branches. All this adds up into the cost as well. Into that margin, it'll start eating up. So basically it is all the processes that are there to run this operation efficiency, right? So now we need to understand what is the efficiency ratio of a bank. Apart from the interest, if you only look at how many, so many branches are required, do they really need to have so many ATMs? Do they really need to hire so many people? Are they efficient enough? So you need to look at how efficient it is, and it is a good benchmarking tool for your bank versus other banks in the industry. Efficiency ratio is basically how much the bank spends to generate its revenue. That's it. It's very, very simple. Now, efficiency ratio of 60% implies that a bank is basically paying 0.6 rupees for every 1 rupee in revenue, right? So that's how it is. Again, if that is the case, then I want the efficiency ratio to be as low as possible, where the bank generates a lot of revenue and gives out as much less expense as possible. So that is what is known as efficiency ratio. Now, the final thing that we will look at in the next segment is the amount of risk taken by the bank. How do we analyze the risk of a bank? That is what we will look at in a very important segment. We will look at in the next part. Now, the final thing that we will look at is how to analyze the risk of a particular bank. Now, it is very simple. If we need to look, we've looked at a lot of ratios right now, but if we need to look at the balance sheet and figure out whether the risk of the bank is high or low, we need to simply look at the assets and equity ratio, right? The total assets to the equity ratio. Now, you can find both these numbers in the bank's balance sheet, and for any bank, generally a ratio of 10 or lower is considered preferable. Anything above that would be considered little bad. Further dive into these assets and figure out whether it is good or bad. There are two things we need to look at. Okay, we obviously know that the bank does a lot of loans. Now, we need to look at what is the strength of these loans. Are these loans good or bad? We need to understand that. So, in these two things, you will see it in the accounts also. When you see their annual report and you see their profit and loss and balance sheet, you will see something known as NPAs, okay, which is called as bad loans. Basically, you need to look at two things when it comes to the balance sheet. The bad loan percentage that they have. Bad loans means people not giving back the money. The second thing you need to look at is the coverage for these bad loans. That means how much money they've kept aside for this kind of bad issues, right? If some bad loan happens, have you kept some money aside to compensate for that, which is allowance for that. Now, what are these bad loans? These bad loans are something known as non-performing assets. NPAs, you would have heard of it. Non-performing assets, or basically non-performing loans, because assets and loans are the same thing for a bank. Now, non-performing loans are basically a loan that people have not done the payment, or anyone who's taken the loan, there's no payment received in the last 90 days. So, anyone who does not pay back anything to the bank in the last 90 days automatically falls into the NPA category or the non-performing loan category. Now, obviously, they're bad. Right? And they can be bad for multiple reasons. For example, suddenly something bad happens to the economy and we go into a recession, or there's an economic downfall in a particular industry and everyone in that industry is not able to pay back the money because they're not making enough revenue. So that can also happen. But for us, it is very important to understand that the bank is giving loans to whom, and is the bad loan percentage or these non-performing assets increasing or not. Because if the non-performing assets are increasing, then I would doubt the ability of the bank that, bank, you're giving all these loans to bad people and they're not paying you these loans back. That means you're going to lose all that money, right? So that is very important to understand. So the non-performing assets or non-performing loans are very important to understand whether a company is healthy or not. Again, the NPA percentage should be lower the better. Right? Very few people not giving loans is considered a good sign, as compared to a lot of people not giving you back the money, which is considered a bad sign. Now, another very important ratio you might have heard is something known as CAR ratio, C-A-R. Yeah, it is also known as capital adequacy ratio. Now, what is capital adequacy ratio? It is basically the ratio of the bank's capital in relation to its risk-weighted assets. Now, you might get confused as to what is risk-weighted assets, Shashank. I'll tell you what risk-weighted assets is. Risk-weighted assets are basically the total assets of a bank, okay, after weighing the risk of that particular bank. Now you'll be like, Shashank, what is this risk? Where is this coming from? Right? Is there some particular formula for this risk? Now, for example, the banks give two types of loans. They give something known as a secured loan and something known as an unsecured loan. Okay, now unsecured loan you would say is more risky because it's not secured. It's much more riskier than a secured loan, which is basically as good as cash in hand or buying some government securities. So unsecured loan is a very big risk for the bank. So basically it takes the unsecured loans and secured loans and finds the ratio with respect to the total bank's capital. That is there. This is the ratio that they prefer. Now the ratio indicates how much capital a bank must keep in order to reverse and reduce the risk of the insolvency and bankruptcy. So for very bad scenario, something really happens, the bank has to keep a portion aside, right? And that is the CAR ratio that it explains. So the ratio basically talks about how much capital, how much money a bank should keep aside in reserve in order to reduce the risk of insolvency and bankruptcy. Higher the CAR ratio, better it is for the bank. That is what CAR ratio looks like. Now guys, finally, I hope I was able to explain in a very simplified, easy format on how to analyze banks. A lot of people have this fear when you talk about banks because the entire profit and loss statement looks different, the balance sheet looks different, and suddenly there are different formulas like CAR ratio, there's a formula like GNPA, NNPA, which might confuse a lot of people. But all I'm saying is you've got a lot of education right now. There are more such definitions on the Groww platform as well. So I think you should learn a lot from this. Try to just take your time out. It might be slightly outside your comfort zone, but take little time out and read one bank's balance sheet and profit and loss statement. And after that, you will know exactly how to read every bank's profit and loss statement, right? So you have to do this once. And again, we're here to become a knowledgeable investor. We're here to become an educated investor. And only by educating ourselves like this, tomorrow, if, we read somewhere that, the number of loans in a particular industry is going to become a bad loan because the industry went into a recession or something really bad happened to a particular industry, we'll automatically know, oh my God, that bank had given a lot of loans to a particular industry. Now that industry is going through a bad time. That means a lot of NPAs will come to that bank, and that means the share price might go down. And that is how you connect the dots, right? So I hope you like this episode. I hope I was able to explain this slightly complicated topic in a very easy, simplified way. And if you liked what I said, please like the video, share, subscribe, and comment below. And again, I will see you soon. So this is Shashank Gurpa signing off.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.